Good morning. Those of you who have joined us already, we're giving our guest a few minutes to get himself situated. He's joined us at, for him, the ungodly hour of 6 a.m. from Honolulu. So we'll give him kind of a little slack here. And we'll give everyone else a chance to grab a little lunch or a cup of coffee before we get started. This is a reschedule of an event that had to be canceled due to, of all things, weather. I believe there was some a typhoon or cyclone or whatever it is they get out Hawaii. It's the equivalent of a hurricane. And so we had to reschedule this. And those of you who joined us received a new link for today's episode instead. Let me at least put up the title for now. This is going to be an interesting session because with everything going on in the stock market and uncertainty over tariffs and inflation, and I don't know whether you've been tracking the price of gold, but it's kind of out of control. This is going to be an interesting, or could be an interesting anecdote, or antidote rather, to that volatility. Give you something else to do. We're waiting for Patrick Grimes, who is a
All right. Good morning.
There he is. All right. As I said, Patrick's joining us from Honolulu, where it's just after 6 in the morning. This is a reschedule of a webinar that had to be canceled due to weather. And Patrick, I think you're going to be joining us on screen. And let me know if you can see the title page.
Yes, I can.
All right, good. There he is. All right. I was just about to go over a few bio details on you. Patrick is a robotics and automation engineer by training, but he took a detour and he is the founder of Passive Investing Mastery. He's also an international bestseller, a Forbes Circle member, and he operates a diversified portfolio of energy holdings, lending, acquisitions, and is going to talk to us today about something that's been very interesting. It's been a thing in investment circles for a few years now. It's litigation finance, and this is the front end funding of legal efforts to usually class action and those sorts of things. Patrick, you can give some background on that. And participating in the settlement as an investor would in the profit of any investment. So I'm going to take my screen down in just a second here and turn it over to Patrick. But one housekeeping, the lawyers, we're going to talk about lawyers today, but the lawyers have to have their say here too. We're a neutral third party custodian and administrator of IRAs and 401ks. So we don't provide investment advice or endorsements, and we can't promote anybody. Everything we do here is educational. We're not CPAs or realtors or attorneys or tax advisors or accounting specialists or investment advisors. So if you need anything in those areas, please consult a qualified professional. So everything here is informational. So I'm going to unshare my screen. And Patrick, if you want to throw something up there, go for it.
Yep, sure.
Here we are.
Okay, I think we've got it. Can you see it all right?
Yes, I can. Fire away.
Well, I'm excited to be presenting to you here. First of all, I have enjoyed my relationship with Camoplan, and I actually had Camoplan on my series as well. I have an alternative investing mastery series, and about a third of the investments that come through our company are through qualified retirement accounts that have been gone into a self-directed variant, and I am one of those. I actually have a one of the 401k variant of the self-directed from some of my past employer 401ks. So
great to hear. Thank you.
Yeah, I really excited about this, and looking forward to digging in with you here today. So really the conversation about litigation finance, goes back for me towards our mission as a company. We at Passive Investing Mastery educate to achieve mastery in the art of alternative passive investments. That's out of the stock market, right? Once you also out of real estate, and really do that by both educating and sponsoring on different kinds of alternatives. We also have one of these, which is a disclaimer. And it means that I'm not a financial professional. I'm certified or licensed. I'm not a CPA, an attorney. And so I'm not going to give you finance, tax, or legal advice during this webinar. But I started as a machine design, automation, and robotics engineer. And that's me here with my forehead sitting just in front of my forehead was the Tesla rotor assembly, a robotic assembly that assembles the rotating part of the electric motor. And behind my head was a satellite solar cell assembly machine for Lockheed Martin. And below my chin was a flu diagnostics test kit. That was later converted to a COVID test kit and then replicated numerous times. And so this is me as an engineer. And like many of you, I was a hardworking machine design, automation professional, hardworking person in the world, trying to find a way to do a little bit better. And it happened to be that the first real job, I had a couple of jobs at Toyota, where Tesla is now, and at wineries, but the first full-time gig that I got out of college was for a machine design firm. And that founder, after a couple of years of me succeeding there, gave me some advice. And he said, don't spend your money in high tech. I was trying to find the best stocks and startups. He said, my only regret was not buying more in alternatives investments outside of the high tech industry and real estate sooner. That was a little bit surprising for me, because he obviously was a 30-year titan in this industry and doing well. And he's basically saying, and he make all your money in high tech and dump it all in alternatives. Don't ride the wild ride. And you remember him saying, the true security and the financial success you want for yourself and your future family will not be in the stock market, and it will be in high tech. So that led me to lose everything in real estate back in 2009 and 10. And so I, snot-nosed engineer, dumped it all into some pre-developments. At that time, it was never, and please keep the questions going. I like it when there's questions. I'm monitoring the chat here. So if there's anything that comes through, please let me know. I'm happy to participate in answering those as I go. But I got into a pre-development, super eager, went all in one investment, went all in one market. And that's what we'll talk about today, what happens when you do that. And then the subprime mortgage collapse happened and everything went upside down, and I was battered and bruised and ego was hit. But then eventually I got a master's in engineering and an MBA, still a successful engineer, started buying stabilized income producing assets or single family homes that were existing, not speculated development, and doing it in recession resilient markets like Houston. And that succeeded. And I traded up to larger apartment buildings. Now we have a fairly large apartment building portfolio. I also write for Forbes. I got some books out. I'll give those away at the end. So I actually have a barcode you can have. I will actually ship you a copy we sign and send you, or you can download the ebook, but we give that away at the end. And we have some energy stuff. And then I said, look, I really, truly believe in alternatives, not just real estate. So we need to start a passive investing mastery as a company. This is our company here that allows us to do various alternative investments. And this is our group of guys now, and there is quite a bit more, but these are the forward-facing ones that you may see or interface with. And so people ask, oh, why alternative investments? Can you see the slides okay?
Yeah.
Yeah, okay. I just got a note saying that they couldn't see the slides.
I'm seeing them here. Is anyone else besides Brian having a trouble seeing the slides? Brian, can you see the two of us, myself and Patrick?
I'll just stop sharing and I'll reshare one more time.
Let's
How about
do that. Yeah, when in doubt. Yeah, he says Brian says he can see us.
I see that there's a dedicated. Yes, I see you. Okay, let's try one more time.
Okay.
PowerPoint camera plan.
Yeah, it says you started screen sharing and here it is.
Okay.
Brian, how about now? I see both of you in the slides. Okay, cool. Thanks, Brian. Appreciate it. Wouldn't want you to miss out.
All right, cool. All right, so, and that begs the question, why alternative investments? Not just real estate, but why go outside of what the popularized investments are? That would be the stock market, right? Why get into self-directed retirement accounts so that you can get outside of those publicly traded stocks and other things like real estate and others? Well, it always makes sense to prepare for market volatility. You don't know when it's going to happen. I didn't know when 2009 and 10 was going to happen. And guess what? Every 15 years, real estate goes through a ride. And we're due for one right now. And while it always makes sense, you cannot forecast the future. There are two kinds of forecasters, those who don't know and those who don't know they don't know. You know, John Kenneth is a really famous economist, but I think we all know that. There are some very smart people out there, some of the smartest people I know, and what they agree on is that they don't know what's going to happen and when. And so it always makes sense. But today, you got to think probabilistically, me being an engineer, it is especially important today to look outside of the more popular sort of real estate, more popular stock markets. Why? Because 11 out of the last 14 Fed rate hikes, 11 of them, of the 14 Fed rate hikes, ended in a bust. And there's the dates right there, ended in a bust. What just happened? We just got done with the Fed rate hike. In fact, when it was measuredly more severe than ones in the past, the Fed rate hike was much faster and much more brutal than many of them have been in the past. And other indicators, macroeconomic indicators of possible recessions, our spending is out of control. We have multiple wars going on in critical regions where oil and some of the more important commodities are controlled, and against the biggest economy. We in the world are in the middle of a trade war. There are many, many, many different, very disturbing, call it today, indicators that we are headed for some tough times. And it's important that we all just take a hard, sobering look at that, right? While it always makes sense to diversify alternatives, today is the day. Today is the day we need to think about it, okay? So keep your questions coming in. I got an anonymous in Hindi jumping in there, and I agree.
Saw that. I saw that. Yeah. They're often behind
100% agree with the Fed rate hike.
Yeah.
Often result in recession. So, am I the only one talking about this? No, I'm not. Morgan Stanley's Global Investments Group, their committee suggests that 25% into alternative investments actually produces what they call an improved risk return profile. What does that mean? Look at these two graphs. That means traditional investments is black, alternatives is orange. You have high return on the y-axis. See if I can get one of these laser pointers. High return on the y-axis and risk on the x-axis. And what does alternative get you? That gets you a higher relative return for a lower relative risk. Exceptionally so, alternative investments typically outperform equities by 25% in bear markets and 29% in rising rate environments. Are we in a rising rate environment right now? So think about it. These are, Morgan Stanley, mostly publicly traded stock company, is saying, look, at least 25%. That is the floor. If you look at other, like Edward Wolf, and we need to fix this, there's an issue here. I'll tell my marketing group. Somehow the numbers are different, but the colors stay the same. But so look at this first bar here, the middle class, right? And this was you can see Edward Wolf here, shows their allocations. And these are individuals worth about under $500,000. They're principal residents, not understandably, takes about 62% of their wealth. Then you have pension accounts and liquid assets. But then when you get to alternatives, you're only about 8%, right? Then when you get to upper income, you have about 25% in your single family home. And then your allocations reduced down to about 25% in alternatives. Now that's really great. That means once you get past this sense of scarcity where you've got your housing and you're covering your basic needs, the middle class, once you start investing 500 to 10 million, they start allocating lots and lots more into alternatives. And then you can see here, when you get to the more wealthy, they have allocations into miscellaneous assets or personal residence. And then look at this, stocks, securities, mutual funds, and trusts. That's buried underneath a 50% allocation, not to be about 8 to 25 to 50%, 49% allocation, and business equities and real estate. So what is that? Business equities and real estate. Another question here about if I'm headed richer, what should I do with my stocks and my real estate portfolio? Any way to take advantage of the future downturn? We'll talk about that in just a second, actually. But here is the allocation of Tiger 21. You've got here, so common, this is the more wealthy end. You see 25% in real estate, you see 26% in business or private equity, right? So you add these two together, it actually comports almost identically to that prior graph, but it does bifurcate your real estate and your private equity. You got some other stuff over here like public equities, your stocks, your hedge funds, your fixed income. We have an income fund, that's important, right? Commodities, a tiny, small sliver. And then cash or cash equivalents. We talk about gold and not just dollars, but cash equivalents, gold and silver. I'm big on that right now, especially in downturns. And so what do you do when you're tapped out? How many people have more than 25% in real estate? Probably a lot of us, right? And that's always the struggle, right? You do one investment, you get really comfortable in that one thing, you get way over indexed in that next thing. And then you need to venture out into something else. That's like a lesser known step. It allows you to get a little bit more allocation, right? And so how do you fill that private equity? Well, the argument for diversification isn't investing in a lot of different kinds of stocks. That's still sentiment-driven stock market. The argument for diversification isn't investing in a lot of different kinds of real estate because you're still driven behind market factors that are the same. Real estate's driven by interest rates. And I love real estate. I got a lot of real estate. We got 2 real estate funds. I big on real estate, but that is an allocation. It's not the end game. Now, the cap rates and stocks, cap rates, interest rates are going to drive that whole market. So where in this private equity, where do you begin allocating? So we say 2 different things. One, we say recession resilience. These are industries that tend to not be affected by recessions. And we say something called non-correlation. These are things that don't rise and fall with the rest of your portfolio. Now, whatever the rest of your portfolio is, typically in the stock market, typically in real estate, if you're going to make another allocation, make sure that the fundamentals behind this other allocation, the market, this other allocation, and don't drive the rest of your portfolio, right? So we got to find those. So what are those kinds of things? Well, the ruse of REITs is something I write about all the time, and I've got a bunch of articles in Forbes, and you can scan that barcode if you want to read it. But financial planners will tell you, hey, you can diversify real estate into REITs. REITs are often mistaken as real property, and those financial planners, those portfolio managers are really, really gunning for that 50 basis points that feeds their family. You want to keep control over your funds, and I don't blame them, right? Because they're kind of a dying industry right now, so they really got a house. You're their retirement annuity, and if they can put you in a REIT, you'll get real estate exposure? No. First, you lack the depreciation, the tax advantages. You lack the hedge against inflation because REITs track with inflation, and you don't have the security of a hard asset. You have a paper asset. Here is the chart where it shows actually REITs. The REITs are the, so you can see here the red. And sorry, the S&P is the red and the REIT is the gray. And if you look at real estate, which is that green, real estate tracks much more evenly over time. But as you can see, the S&P 500 tends to correlate almost identically over time with REITs. Almost identically over time with REITs. So what does that mean? They're correlated. That means a REIT is not diversified with your S&P investments. It's not a diversification play. It's not true diversification play. You have to invest into the real product. So besides real estate, what are some of these other things though? Because a lot of us have already been there, and there's a lot of real estate investments, a lot of syndications. We have a couple. You know, what can you get into? Well, we talk a lot about things. And at the end, I'm going to let you scan a barcode, which is Patrick's favorite alternative investments that anybody can invest in today to start building more financial security into their portfolio. Because it's not just independence like I have. Like you can be all in one investment, in one market like real estate, get all this cash flow from your rentals or your investments and have independence, right? But you don't have security. Because if one market swing can take you out, you're not in enough pillars with enough foundational investments in different markets, you don't have true security. How do you get that? Well, you got to look for some of the lesser known stuff. There's oil and gas, right? There's the good, bad, and the ugly there. It's a little scary, right? Because the commodities go up and down. Excuse me, the risks of putting a straw in the ground and not getting anything. In my lead magnet at the end, I talk a lot about that. I got a bunch of different, my favorite investments. I talk about the different ways to invest in oil and gas. There's gold. There's not just gold and silver. There's actually technology metals like gallium. They've been hafnium and indium and all the things that make up batteries, that make up solar cells that are required for basic motors, and these are these rare earth metals that have been in the news. You can actually invest in those directly and get a technology play, and it's all yield growth, a yield play where you can actually get returns as opposed to the store of wealth. We also have other things in here like self-storage, right? We have ATM machines, we have Forex. In fact, we've done webinars on all these topics so far, and Alternative Investing Mastery Series on our site. We host different alternative investments every 2 weeks, a panel of people every 2 weeks, completely different alternatives, including Camp Plan. They come on and talk as well. And housing, Broadway musicals. I have a friend in LA who puts together investments to invest in Broadway musicals. That's non-correlated, right? Toffee and alcohol bev. We've got cask, bourbon barrel cask investments, EV vehicles, and apartment buildings, right? But it's just one of many. So let's talk about when you look at an industry or you look at an investment, why would you choose it, right? Let's talk about maybe some non-correlation and some store of wealth. We're talking about this earlier. Traditional safe haven assets like gold, and some people also say oil and gas. Some people add that in there. But safe haven assets, inversely correlated or counter-cyclical. So gold, for example, stock during crises, gold tends to go up when there's a stock market crisis. Right? People tend to safe haven out. Like today, like my gold investments are up like almost 60% just in the last couple of years. It's like mind blowing. I'm like, this is amazing. It wasn't very popular before, but I knew if I had a balance in my bank account with inflation, I needed to lop that off, and I needed to get a lot of that outside of an unsecured balance above the FDIC limit. I needed to get a lot of that off into a cash or cash equivalent. And man, I'm glad I did, because for the inflated dollar, I've made that back 10 times in the inflation and the growing price of gold during this time. And it's inversely correlated to the US dollar. So dollar goes up, gold goes down. As the dollar goes up, as the dollar goes down, gold goes up. And they say an ounce of gold could buy a suit 100 years ago and still can today. So what does that actually look like? Well, here's the chart. Here's gold in the S&P. Fairly easy to see. And when gold goes up, the yellow line, S&P is just sort of or lower performing. But then when the S&P takes a ride up, gold goes down. And when the S&P goes down, gold goes up. And likewise. For a short period of time, we've seen a little bit of trending together. But for the most part over time, gold has been inversely proportional to or shown a non-correlation or inverse correlation to gold. So that's a good example. What about the US dollar? Here we are, gold versus US dollar. This is about as clear as it gets, right? So the US dollar goes down, gold goes up. US dollar goes up, gold goes down, right? This is what this means. That's why you have a cash or cash equivalent that is non-correlated, low correlated to your dollar, right? If you need help buying gold, we can help you. Low correlation with stocks, so now we're talking about oil and gas. Now, why do people jump to oil and gas? So you got maybe you've got some gold, maybe you got some silver, you probably haven't got into technology metals. You're in real estate, you're in the stocks, where do you go next? Well, very popular for high income earners like you, probably me, is oil and gas. Why? Because you get these big tax offsets, right? But shoot, do they fit the bill? Well, they're low correlation to stocks, right? It provides a hedge against inflation and stock volatility, mostly because the inflationary numbers are heavily driven by the price of oil, right? Because that is a big part of that inflationary number. And they have diverse types of investments in this sector. And I have, and in my Patrick's Favorite Alternatives, I try to break that down for you and try to demystify that a little bit. There are working interest, which is direct drilling. We're talking putting a straw in the ground. There's early on investments. There's later ones that are, one is a total wildcatting, super risky. There's later ones with proven undeveloped sites. And those have large risks. Also have large tax write-offs. Why? Because like food, housing, and energy, the government needs to subsidize. They need to fund us, the private sector, to put money into it to do it. Why? Because the government does not house, feed, and energize America. They rely on the private sector to do it in the United States of America. And those are risky. Housing, food, and energy are risky. So people aren't just dumping the money in there on their own. They need an incentive to do it. So the government's doing that. Huge tax write-offs. Those are deferrals, not the tax doesn't disappear. That recapture happens, but the intangible drilling costs provide 60, 70, 80. We've had 90% offset. I've invested 100 grand and seen a $90,000 reduction in my taxable income in a year. It's amazing, right? I mean, and if that deal performs, it was a good use of that because on the back end, I have a recapture of income. But if that deal performs in the meantime, it was a really, really good use of those funds. Now, mineral rights, long-term cash flow. In fact, I haven't received this myself, but through my family, my mother's currently drawing on it, but through my family, my great-grandpa Kaiser had some oil fields, right? He was an entrepreneur. And through the years, that dwindled down to my uncles and aunts, and their families, and also my mother. But that has been a multi-generational income source. And we've seen it go up since I was a kid. I've heard, seen it go down, seen it go up, seen it go down. So we've seen that generational wealth potential of mineral rights or royalties that provide long-term cash flow. And that's great cash flow. It's non-correlated to the stock market and real estate, right? That's pretty cool. Something to think about there. But there's volatility in that commodity. It's part of a diversified portfolio. Maybe when real estate's not cash flowing or you're not giving your dividends in your stocks, you're probably going to be getting still income from maybe your oil and gas. Here's a good one for you. Pop quiz. Is gold correlated to oil and gas? Can somebody answer that in the chat? Meanwhile, what is Tiger 21? Tiger 21 is a very large, somewhat infamous and very selective group of high net worth individuals in the United States that have over 20 million net worth, and they have to go through a very rigorous process. And as part of their membership, they have to disclose and defend their portfolio every year. So there's a lot of transparency, and they publish that. That's why we have visibility over there. Wow, so REITs are a lie? Yes. They're not, they're a lie if somebody's trying to tell you it's real estate. For oil and gas, should I wait to the end to determine how much to write off I need? That's a really good question, Brian. You really can't make a determination. You can only really do it two ways. I'm not a tax professional, but you can either take it all in 1 year or you can amortize your indirect drilling costs over 60 months, I believe it is, so 5 years. But you can't just make a decision somewhere willy-nilly in between. That's unfortunately the case. That's my understanding, but you can check with your CPA on that. So pop quiz, is this survey says yes, based on what you see right here in front of us, oil and gas and gold unexpectedly is correlated. Look at that. So your gold is not a diversification to your oil and gas. Man, remember, we're having a real conversation here about what is true diversification. And it happens to be that, as that graph clearly indicates, that gold and oil and gas is correlated. And both are alternative assets and safe haven investments, but there's a positive price correlation at least 80% of the time over the last 50 years. And there's data that suggests it really goes back to the correlation between gold and oil and gas in the BRICS nations, where much of it is mined or drilled for, right? And Shifting market circumstances have affected both. Very interesting, right? So say you've got some gold, and maybe you're like, I'm not real sure about oil and gas. That kind of worries me. Or maybe I'm in oil and gas. Maybe I'm in real estate, stock market. So that's it. There's nowhere else to go. So, but you're like, well, wait a minute, my pie chart. I went home last night and I listened to what Patrick said. I did my pie chart. I created my pie chart. I said, look, here's what I have in stocks. And I have maybe a rental, maybe an apartment syndication or mobile home park. That's all one. That's all one pie. That rental, that syndication, the apartment building, whatever. I've got a car wash. All that's one, right? Piece of the pie. And I got stocks in the real estate. And I got some cash. Man, I'm worried because Patrick said he lost everything one time in real estate. And the stock market's headed for a bust. What does that mean? I feel a little worried about my retirement account. It'd sure be great if I was able to add one sliver of that pie in a completely different market, one that doesn't rise and fall, that's non-correlated with the rest. So what does that look like? So how do you even choose that? Again, at the end, I have Patrick's favorite alternatives that are non-correlated. Anybody can invest in today to build more security, not just independence. But here you go. What are the ones that are my favorite? Well, it's the lesser known ones. The lesser, and people aren't out there talking about, let's go invest in healthcare. Why not? People get sick in recessions. I'm recovering for a little cough. Or education. People need skilling and upskilling regardless of market fluctuations. Utilities. There are utilities out there that you can get dividends in that are needed regardless of market ups and market downs. Legal services. Legal services is interesting. Why? Because it's not only touted as having low correlation or non-correlation to the markets, but some people even say it's inversely correlated. Because when times get tough, people become more litigious and attorneys just get busier. And that's kind of fascinating, right? Other ones that are not on here, plumbers and HVAC, service-oriented type industries that are just needed. You know, I got a friend that works for an asphalt company. Regardless of the market, they're building roads, they're repairing roads. So there's a lot of investments out there. Why do we like legal services? And we talked about litigation finance was the beginning. This is kind of a big lead up to this, right? But I created this graph myself. Anybody can go out there. They can plug in this URL down at the bottom. It can add whatever industries they want. This is the Federal Reserve data. And what they're looking for is volatility of broader markets and the stability of legal services. What we're looking for is both non-correlation and recession resilience, okay? So here's the subprime mortgage collapse, and here's some COVID, and look at the different markets. Holy cow, look at oil. Go for that. I mean, we knew that right existed. Now keep in mind, these are just measures of not necessarily absolute values of each of these. These are measures of just the volatility of these things. But look at this oil and gas. Man, that really went for a ride. Look at the stock market. And that really went for a ride. Look at the USD. Shoot, that really went for a ride. Even gold. Gold, the yellow one's going for a ride. What about legal services? Straight as an arrow. Straight as an arrow. Now, why is that? Well, the reason why is because different economic conditions affect different assets differently, different markets differently. So the graph, this clearly shows dramatic volatility in common popular markets. So why are we so excited about gold? And why are we so excited about real estate? Why are we so excited about the stock market? If they're so crazy volatile. And you can actually access other markets which are less volatile. Legal services show steady growth. The outcomes of cases aren't affected by the market conditions. The amount of awards or settlements offered to harmed individuals are not affected by market conditions. The legal industry is just very simple. You have attorneys and you have claimants. You have clients, right? And they need to be able to pay their bills and they need to provide representation. And it's a large industry. People don't realize it's really like 849 billion is the legal services industry. Just mass torts alone. We don't do class action. We do mass torts. 443 billion. Those are really big numbers, right? It's about the size of the global airline industry. It's just lesser known by us, but it is a really big industry. It's a huge industry, well developed, a lot less complex than the global airline industry, that's for sure. Far less risky. But where does those funds go? So we do what's third-party funding. We're accessing litigation. We're accessing in legal industry through financing litigation, helping attorneys working on a contingency fee basis, right? So how does that break down? I mean, they're in those numbers. You have some mass torts, which are thousands of people similarly harmed by one defendant, the evildoer. You have common litigation, commercial things where there are disputes back and forth, a single event type disputes, and then you have personal injury. You've probably seen these billboards like I got hit here, or it's whatever it is. If you need to, that kind of stuff. Don't do a ton of that. And the United States does play a big role in that. There's about half the, there it is. So the black one there is the United States, about half of it, the dark blue, about half of the litigation funding, third-party litigation funding. So what is it? What is it? We're solving needs in the legal industry. So we don't actually do class action. I want to say that class action is something like I've somehow been involved in like a half dozen class action lawsuits, and I stood to make like $40, $60, $80. They're meaningless. Nobody really gets justice in a class action lawsuit. The outcomes of those cases, they're not meaningful and they're not true harm being done. I mean, it was like, I worked at Radio Shack during college, and because I skipped my lunch, they gave me $70 or something as compensation. I was like, what? I don't even know. But we don't have anything to do with that. We're in something different. It's called mass tort, or a single event like sexual assault, right? Things that are really devastating. Now, where this fits in the world is when you want to access an industry because you're saying, man, this industry, like the legal industry, is great market fundamentals. I would love to invest there. Is there a way where I can solve a need for somebody and I can get a return? And that works really well. Why? Because there's a bunch of attorneys out there that are working under a contingency fee basis. That means they're representing somebody who can't afford to get justice, right? So they need the funds in order to pay themselves, their hourly rates, their court fees, the filing fees, pay their rent so that they can provide access to justice for those that otherwise couldn't afford it. Well, that's a great lending environment. You got really high balance sheet operators in the legal industry with a track record. These individuals, they need funds. They have shown the ability. They're in these cases. They're in these stages, late stage. It looks like they're already working on settlements. We can underwrite it. We can give them a loan, effectively a loan. It's a little bit different. It's an investment, but it's effectively a loan. We can lend to them on a value of their collateral, and we can help them get across the finish line and participate in some of the settlements. So, kind of just demystifying it here, because there's a lot of big words. What's interesting about being in America is when there's a wrong or injustice, right? That's called a tort. Comes from the word tortum in Latin, wrong or injustice. The harmed party, a person that's been harmed, here we call it a claimant. They're staking a claim, or they're the plaintiff, meaning that they're making a complaint. So just demystifying some of these words. In America, they may seek justice, right? They're not at a loss. The harmed can sue the responsible party. And call that responsible party the defendant through litigation. And what is litigation? Sounds scary, but all it is resolving the disputes through the court system. When numerous, fucking thousands of individuals are similarly harmed, their individual lawsuits are consolidated. This is called a mass tort. This is a big deal. Thousands and thousands of people similarly harmed by one big evil institution. We'll look at some examples in a second. Well, it's called a mass tort. They're not like a class action where it's one lawsuit. It's thousands of individual lawsuits, okay, against one defendant. Why litigation funding? Well, these harmed individuals often lack the funds to pay the attorneys up front, leading attorneys to defer payment until the settlement. Mass torts are very, very expensive for the attorneys, and they result in significant settlements or judges, meaningful settlements like $100,000, $400,000. You're going to see some going to the harmed individual. And investors can enable access to justice by funding attorneys to cover the court costs. That's litigation funding. It's third party. 1910 was the first time litigation finance or a third party came in to fund litigation proceeds in America. And it was when a bunch of people were walking around like, oh man, I've got all these horrific illnesses now. It can't be cigarettes, could it? I mean, I've been smoking cigarettes, but they say these cigarettes are healthy for me. So is it the cigarettes? Have they been lying to me this whole time? Has American Tobacco been lying to me? I think so. So what did they do? They got a bunch of people together, and third parties funded these disadvantaged people dying over these horrific illnesses, and they funded them to be able to go up against American Tobacco, and these attorneys won. They prevailed, created social change in America. And it was the first time third-party funding was able to help the underdog actually overcome a big evil organization. They discovered that they knew it was harmful, and it was a web of lies. And so that's the first example here. So simple comparison between real estate. We have a debt fund. Real estate operators, we lend to real estate operators in our debt fund, just like we lend to legal operators in our litigation finance fund. We call it a prepaid forward contract, and it's more purchasing and selling a prepaid forward. But for all intents and purposes, we'll call it a loan to the legal operator. Now, we have in the real estate market, we're lending so that the owners of the real estate property can either buy the real estate or improve it to provide housing for tenants. We're lending to attorneys so that they can either acquire more clients or claimants to add to their existing case, or the operating expenses to get them across the finish line so that they can provide access to justice for those that can't. We will value real estate with an appraisal. We will value the corporate assets of the attorney with a law firm valuation specialist. Just like an appraiser, they go in, they look for, hey, what are your cases? Who are these people? Are they real? Excuse me. Do you have the right health records to say that they were harmed? Do you have proof of exposure to say they did work in this location or exposed to this chemical or this product? And does it fit this case that you're working on? What are other cases that have been settled, or have they already settled this case? How can you place a value on that? Just like you do in real estate, you have a valuation of the collateral. And then we can lend 10, 20, 30% litigation finance is our target against that collateral value. And in real estate, man, we're at 60% in our debt fund, but real estate can go 70, 80, 90%. I mean, there's a lot of crazy things going on in real estate. And you put a lien. In real estate, you got a mortgage, deed of trust, and litigation finance, you have a UCC1 filing. So you have the security. So it's an asset-backed lending strategy, just like any kind of lending strategy. If you bought a home, you understand litigation finance. All the same steps are there. So we're going to skip through some of these slides. But really, what's important is case selection, partner selection, balancing new client investing to help the attorney get new claimants versus collateralizing their existing clients, and structuring the agreements properly and deploying and monitoring your funds. So here's an example, and this is probably the best way to understand, like we have thousands of these represented inside of our diversified litigation portfolio. Camp Lejeune water contamination. This is the DOJ. This isn't even a private company. For 17 years, they knowingly fed contaminated water with these horrible ingredients to the military and civilians and their families that were at Camp Lejeune. And this is a little bit hard-hitting for me because I was born in Italy because my dad was in the Air Force. We moved around a lot and lived on bases. Holy crap, it's the United States of America doing this to those who are we call this the Land and Liberty Fund, Land and Liberty allocation. They knew about it. There was Agent for Toxicology and Substance and Disease Registry published linking all this exposure to horrific cancers and birth defects and diseases. Bipartisan legislation, Republicans actually agreed on this and said, look, this is horrible. They published this grid saying, look, based on what condition you have in your medical records, here's your tier and how long you were at Camp Lejeune. And this is where these guys went to train for war. Here is your payoff. And you can just get this today. You can actually get this today. In fact, they're going through the process of targeting more specific conditions and cases to increase those numbers. But today, this is the current settlement grid. We call it the early settlement grid. The U.S. Judgment Fund was put in place with no capital limit. And so this is an example. We have a couple thousand of these. I think we might be pushing like 3,500, 4,000 of these inside of our fund. Helping those get meaningful settlements. That's really going to make a difference, right? For either the harmed or their next of kin. And then RoundUp or paraquat. We've all probably heard about this or seen some of this, but farmers and landscapers basically bathed in this stuff, and they were told it was safe, and there was reports published by the EPA saying, yes, it is. Well, turns out that was all fraud, and it was not true, and those reports have since been pulled back, and discovery is done indicating that Monsanto now Bayer knew about this harm, and they still haven't changed the product. We believe that they're working on it now. They manipulated the scientific studies, and it is when they have won significant lawsuits, 10 billion, 300 million, 300 million, 1.5 billion, 2.25 billion, 80 million. So can we, if an attorney comes and says, look, I have these individuals and here's their proof of exposure and here's their medical records of show harm, can we understand what the settlements are? Yeah, we have a really good idea on a per claimant basis how much they're settling for. So there's some real value there. Labor claims, I was a victim of this. I was out of California. I was a machine design automation robotics engineer. Tough times in the company. The guy booted me, and he owed me like 40 grand in back pay. And I didn't even, and I had to go to the labor board, go to Santa Barbara labor board, report them, and it went through the process, and I got it back plus penalties and liquidated damages. But not a lot of people can do that. There's a lot of this wrongful termination issues that are happening. And so we are participating in a portfolio of essentially one-off that help people get access to justice that otherwise couldn't or wouldn't know how. Other ones like water contamination, forever chemical water contamination. We talked about paraquats like RoundUp. And you see infant baby formula, toxic baby formula causing horrible diseases and medical conditions inside of premature babies, and sexual assault. We actually just won this really cool case. You go to LA Juvenile Detention Center, you're going to see sexual assault, billions of dollars going to those who were assaulted over decades at the LA Juvenile Detention Center. And that's a really good win for us, really good win for our cause. Baby food, heavy metals, and Suboxone, all things that are currently targeted by us. Strong evidence and strong cases, strong as what we're looking for. So not speculative early staged, wildcatting oil and gas drilling type investment, not speculative early staged angel investing type investments, or not speculative real estate development like I lost everything doing back in 2009 and 10. We're talking very late stage in the courts, which we actually address here. So, I mean, this is kind of like the mass tort timeline. Lawyers begin pulling cases together, but for like 5, 10, 15 years before that, the harm was done. Then they begin introducing them to the courts. Finally, a court says, look, we'll go ahead and consolidate all these and we'll try all these simultaneously. Then they go through all these trials, proving what we call causality and liability, which is, I don't know why I did the air quotes, proving causality and liability, which means that this defendant, that this chemical caused it, or this exposure product caused it, and caused this illness in these harmed individuals, and liability, is the defendant liable for that? Did they withhold the information? Did they hide? They go through discovery. You get to battle the experts. Once all that happens, you got to keep in mind, 90% of civil litigations settle, right? So it's not necessarily a binary win-loss once you're this late stage. We get involved when there's, like I said, there's already a grid, or there's already been similar settlements in similar cases, or case law, or they're already engaged in a settlement dispute. And so you have a really good understanding at that point of what they're going to settle for. And you get into a large diversified portfolio across lots of cases and thousands of claimants. And so you've really got a great risk reward profile right around this sweet spot here, called late staged cases. We haven't settled yet, but we're right in the middle of that. And numerous times we've been in the middle of a case and they've gavelled down and said, no more claimants, we're settling. Camp Lejeune and the sexual assault are good examples of that. So balance new claimants, which is where we invest to help the attorneys continue to fund their marketing, to have more and more and more claimants similarly harmed, to make them more scary to the defendants, versus collateralizing their existing claimants. We can do a combination of those, and we typically do. Obviously looking for litigation partners with a lot of experience. And we balance kind of their existing claimants with new claimants. We do very low loan values, which helps us have a lot of fluctuation in the valuation of those cases before it gets to us. 10, 20, 30% gives a huge cushion, right? Getting preferred payback terms whenever possible with our clients. That means that all of that volatility that may happen in the case value comes out of mostly the borrower's pocket in the cases that we do preferred payback terms. There's a sense here that's kind of neat. I mean, we call it investing for profit and purpose, and it's not an ESG or impact investment like this. That isn't it. I mean, technically there's some aspects, but that's not the intent here. But it is good that in our real estate deals, we provide a cleaner, safer, and improved living experience for our residents. It also is good in our litigation funding that we actually help provide meaningful outcome for the harm that otherwise couldn't afford it, right? And it increases access to the justice, right? It enables attorneys to engage in contingency fee-based representation, or else it wouldn't happen. The individuals that can't afford it wouldn't be able to, could be preyed upon, and they wouldn't be able to get justice through our very expensive legal system. It levels the playing field between these big bag defendants by joining together with these attorneys, and it targets corporate misconduct or government misconduct, as some of the cases that, in fact, like the sexual assault cases. That was in my backyard, going on the whole time I was there. Crazy. Generate fair compensation, meaningful settlements to the claimants, right? Meaningful settlements is really our, we're not ambulance chasers. We're not predatory. We're looking for cases that actually matter, if you can see the theme here. And we deliver sustainable returns for our investors. So that was the end of that. We have an alternative investing mastery series I would like to invite everybody into. Seems to be moving forward on its own. I have an alternative investing mastery series. This alternative investing mastery series, every 2 weeks, we including Camel Plan, we present completely different alternatives to this real estate, completely different alternatives to the stock market. We have an amazing group of individuals that come on there, including Camel Plan. And if you're looking out there as my blue ocean approach at just bringing every possible different, I mean, I used to trade the baseball cards of alternative investment strategies with just a couple guys for a long time. And there was really just very few people that knew about all these. And I started by saying, hey, look, here's my hand. And our investors loved it so much. I said, look, I'm going to show you the whole deck. I'm going to show you everything that I'm exposed to. I'm going to unveil it. And it's a blue ocean approach. Certainly we have investments, but I believe that in order to have a diversified portfolio, you need to know about all the options out there. It's education I wish I had when I was younger and I knew more about the availability of these. And so we do that. Please jump over to our website. I'd be happy to help you out with that. We also have a book. I said I would give it to you at the beginning. If you scan that barcode, it takes you to our website. Make sure to put Camel Plan in the promo code, or else I won't send it out. You can certainly download the ebook, but I won't send it out if it's blank. If you're random, we don't know where you came from, I'm not going to sign it. We're not going to send it out. But I'll send you a physical copy. I mean, it's pretty neat, right? I'm right here, the engineer, the nerd sitting next to the Navy SEAL, and you've got Phil Collin, the lead guitarist, the Def Leppard, an actual rock star. John Ziegler, Brian Tracy did the foreword. There's so many cool people, entrepreneurs. I did a chapter. I tell my whole story, the ups and downs. Happy to share that with everybody. Make sure you scan that barcode or go to passiveinvestingmastery.com/book. Passiveinvestingmastery.com/book is the secret link. It did make the Amazon #1 bestseller. Actually made an international bestseller, from my understanding. Lessons from thought leaders. Hope that adds to your journey in life. This next one, PIM Wealth Accelerator. Once you get on our list, by jumping on it, every Saturday I snipe you, and Saturday morning around 10 a.m. Pacific time, I snipe you with some new lesson or journey that I went on through my investing career. And we call it the Wealth Accelerator because I talk about all kinds of things. And I really enjoy it. I like to give back. I like to spend the time. Part of that also is articles I write on Forbes. As we said, I have a lot of publications out there. If you want to read more, go ahead and scan that barcode. We have a lot of publications, a lot of education for you. And there's podcasts as well that I'm on. You can access on our website. And if you'd like to meet, part of what I love to do now that I've sort of gone full-time away from engineering, and I'm a full-time investor and I've got my 2-year-old, and I really like to build those relationships with investors. So regardless of where you're at in your journey, set up a call. Love to chat with you. Love to, if we're a stop along your investing journey, that's great. If I'm pointing you off to one of the dozens and dozens and dozens of alternatives that we have hosted on our mastery series, that's also great. It's a big blue ocean of opportunities, and we all win together as we build more true security into our alternative portfolio. I think the last thing I'm going to leave you with is this one. It's the most common question I get, and it's how to unlock your financial security with non-correlated investments. So this is Patrick's favorite alternative investments all in one spot. And the first page just lists them. Anybody can invest in these to begin immediately start building more security. It's a non-correlated investments. And then on the subsequent pages, I drill into each of them. So you can kind of choose your own journey. But I ask this question so much exposure, so many different kinds of, what are my favorite ones? What should people think about today, right now, to start investing in? And that's what that's all about. Certainly, if you're interested in chatting further, you have questions, your investments, you can add me to your contacts here. That is my personal mobile. Good friends with Camoplan. So for Camoplan, happy to share my email and my mobile with your group. And that's it. That's all I've got. I appreciate you having me.
Wow. Good stuff. Lots of fun. There's some,
3 minutes to spare.
there are some questions. I was busy doing the downloading while you were wrapping up there. So I'm going to take a look at this stuff. Well presented. There's a few questions in the, can you see them, Patrick?
Yeah, can you
please some comments and there's some comments,
again?
But there are a couple of questions towards the, something about a third party study on the roundup, how they, I guess how they find that out.
Let me see. So, right into a session, what should I do with my stocks or real estate portfolio and way to take advantage of future downturns? Well, right now you have a really interesting time to be able to get involved in some completely non-correlated investments. And I like I mentioned, for your cash equivalents, gold is killing it right now. I am currently and have been always allocated into some cash equivalents. I do think you should leap towards, especially right now, some of these recession-resilient, non-correlated options, ones that tend to perform even regardless of economic downturns, like litigation finance, like healthcare, like education, CPA firms, HVAC, these kinds of investments. Those are the ones that you see a lot of the people going into and sort of lessening their allocation into the stock market. I do think we have a very unique time in commercial real estate right now. In fact, commercial real estate right now is basically going through what single family residences did back in 2009 and 10, not because of the mass fraud, but because of the skyrocketing interest rates, because of the record high amount of short-term bridge debt, which was put on commercial real estate that's coming due right now at a time when those interest rates reduce valuations. Valuations have dropped, and COVID put everybody behind the 8 ball. Why? Because the eviction moratorium means you couldn't collect rent in some places for 18 months, meaning your capital reserves have basically been depleted. You couldn't get those people out. You couldn't evict them. So that means your occupancy was reduced, your ability to collect rent. And you're on the outset are now in an inflated environment. So your payroll and material costs have skyrocketed at a time when there's been a lot of natural disasters. Whether you believe in global warming or not, insurance has increased by 20 or 30% or 2 or 3 times in some markets, or if carriers are completely picked up and moved out of town in some places, especially in the more favorable traditionally favorable places like the southeastern states and Texas, right? So there's these are core fundamentals. So right now there's a very interesting time to win from the upside of that downturn, as you kind of eloquently put it, in commercial real estate, both in lending, when those operators need more time, there's high interest rates, the banks have a liquidity crunch and they're sitting on the sidelines. So we do a lot of lending in our income fund, and opportunistically, where instead of 6%, we're getting 14% on those same loans. That's pretty amazing. And we buy properties in cash right now, just like people bought a lot of cash assets in 2009 and 10 in residential single family. We're buying a lot of cash right now in commercial. So anonymous attendee, hope that answered your question. Appreciate the comments about the great chart. Answered the question about what Tiger 21 is, also about REITs. If I believe in the dollar, does that mean I should not be in gold? You're going to have a really tough time believing in that dollar if you look at the numbers for long. I think you need to really look yourself in the mirror and come clean with your false beliefs there, man. For oil and gas, should I wait until the end of the year to determine how much? I think we already addressed that. You can't do that. If I have $1 million to invest and want to invest 100K evenly in 10 different assets and alts, which asset should I choose for max diversification? I don't know what you're currently in right now. So what I would say is, first of all, I can't give investment advice. So I'm not a financial planner, an accountant, or an attorney. So it can't be financial, legal, or tax advice. But I'll be happy to chat with you. This is a broader conversation. It has to do with what assets you're in now, your current portfolio, and your level of risk, and where you're at in life. Are you at a growth mode? Are you at a point where you're looking to go into store of wealth and just cash flow? There's a lot to answer there. So happy to scan that barcode right there, and let's meet, or shoot me an email or a text. Legal services so stable, wow, perfectly up and to the right. I know. It's like not every investment has to go for a ride, right? Some of them are a little lesser known, maybe a little more boring. Attorneys are not the most exciting people, but they have a great industry that's stable. CPAs are also not the most exciting people, but they're in an industry that's very stable. So sometimes you got to go for what's less flashy, right? To get what's more resilient. LOL, class actions are only good for the lawyers. Agree on that, anonymous attendee. That's so messed up. Not sure. Oh yeah, probably about some of the cases. Did a third party do the study on RoundUp? Are they also in trouble? Oh, of course. Yeah, so there's been numerous studies and numerous cases lost. There was discovery done to show that they falsified the data. And they determined it was too risky to change the product, risky to their bottom line, so they continued to sell it. They are now finally trying to come up with a new formulation, but they just continued to pay these payouts for many, many years to settle these cases because it didn't exceed the revenue and profitability of the product, which is so devastating, right? But which mass torts have the highest payouts? That's a question to potentially talk about at another time, but it's not just, mass torts tend to be a range of lots of lawsuits. So it's, as you saw in that Camp Lejeune one, mass torts are a consolidated, they're all individual lawsuits. So it depends on within there, they have different exposure and different symptoms, different medical conditions, right? And those pay out different amounts. And so one mass tort doesn't have like one payout like a class action. It's a lot of different lawsuits, and they try these cases and they figure out what the right compensation is based on your exposure, based on your condition. So it provides more meaningful and reasonable settlements to different kinds of harm that was been done. Really good question. Brenda, which QR code? Brenda says, can you please put the QR code up again? All this is available on my website. Brenda, which QR code did you want? I guess I can kind of flip through. I can kind of just go back on, this was my non-correlated investments guide. This is the one where I say, hey, look, here's my favorite non-correlated investments that you can invest in now. This next one is, we actually have one in here about 1031 exchanging into syndications. This one is for us to meet one-on-one. Go ahead and screen capture, take a picture of that if you want to, or you could just go to passiveinvestingmastery.com. That is sitting right there on my website. Then I think the next one that was somewhat interesting was this book one, I think. So if this is the one you were looking for, if you want to scan that, we sign them and send them out. So hard copies. If it helps to, get you along your journey, Brenda, happy to share my journey and that of my colleagues, which is a really fun book. These guys are pretty amazing. What do you mean that lawyers aren't the most exciting? I love the show Suits. Okay. All right. Try and get into a business transaction with an attorney. You'll see what I mean. But you have it up now, Brenda. Great. Okay. Well, wait, hold on. Thanks for all the cool guides, Anonymous Dindy. Appreciate that. Thank you so
definitely.
much.
Thanks.
Yeah. All right.
This is really good stuff, Patrick. I know we're past the hour, but we don't stop the tape if there are questions. So anybody who has additional questions, please submit them. I just have one. In terms of these, mass tort, um, I clerked for law firms back in the Stone Age when the asbestos suits began. And that
Mhm.
had kind of a life cycle because at that time they were targeting people who'd worked in shipyards during World War II and things like that. And that cohort has largely passed. I mean, I guess the chart you presented on the timeline when the initial suits are the research is done, the initial suits are filed, a benchmark is created by a settlement, and then you move in. So are you keeping an eye out for what's next? I mean, this is an excellent thing. I would imagine that the claimants receive the proceeds and really they continue to add. You see the television commercials. If you've been injured by this, call this. But at some point, that cohort goes away. And so for some of these things have a rather limited duration and it's a limited audience. The number of people who went to Camp Lejeune during that period of time is defined and that sort of thing. So how are you looking out for the next, how do you keep your antenna up for what the next early stage is going to be that you will again take up at the late stage?
Well, so there's dozens and dozens of these cases. And what I'll say is what's really great is my partner, David Gooseman, has been doing litigation finance for over 10 years. In fact, during the subprime mortgage collapse, he was at Fannie, setting up Fannie Mae and in charge of some of their subprime mortgage portfolios. And so he was a participant in spending hundreds of millions of dollars going up against essentially the fraud by the entire street in Wall Street. And they collected over $20 billion through that effort. And so back then, he was spending hundreds of millions, collecting billions of dollars in litigation financing. And that's what really was the aha moment. Since then, he's been in the flow and has been allocating mostly for large hedge funds, sovereign funds, 10, 20, $50 million check sizes into litigation finance. And I had reached out to him several years back, 4 or 5 years back now. Hey, we were dueling on apartment investments and he was flying to my deals and he was one of the sharpest guys I've ever met. He's held senior director level finance positions at billion-dollar organizations. And we really developed kind of a mutual dueling sort of relationship on these apartment investments. And I said, look, man, I want to get into some alternatives. And I knew at the time he was working for some large private equity firms like Obra, Angel Vest, ones that are kind of more known by pension funds and stuff like that. And he was doing lots of interesting stuff like life settlements, as well as Amazon warehousing, completely different private credit alternatives, but a major focus in litigation finance. I said, look, I want to invest in this now. And he wouldn't take my checks because their minimum was like 20 million. So we did, but he finally hung up his hat in private equity, moved from New York to California at a point where he's like, I want to be closer to the family, closer to my mom, and called me up and said, hey, Patrick, let's set up a fund together. And so that's why we were bringing what is like one of the first ones that make it accessible to accredited investors that we found that's a true diversified litigation portfolio. Now, he is in the flow to answer your question. So it really comes from 10, 15 years of having those relationships with these attorneys to find those niche opportunities to invest $500,000, to invest 1 million, to invest $1.5 million or 2 million per in a portfolio versus the 10, 20, 50 million. So that's where the majority of it comes from. It's also important to say that when we invest in all these mass torts, it doesn't have anything to do with when it settles. So to your point, these kind of have a 7-year life cycle, and there's lots of them going on out there. And so we need to find, as you point, ones that are long term. You've seen in the courts, they've causality and liability established. You've seen them negotiating settlements, and you start to get a feel for now you can underwrite what the case value is, right? And at that point in mass tort, that's when the bus is moving, right? We'll jump on with an allocation, right? And the bus is going to stop on its own. So and we typically go for ones that are 2, 3, 4 years, look like they're going to be settling on the outside 5, so that we build a diversified portfolio and then we shut that down, and then we'll see that out, create another one.
Gotcha. Excellent. Thank you so much, Patrick, and thanks everybody for the great comments and questions. We've got a pretty lively audience here. you've been able to see. Patrick, again, appreciate this, and those who want to follow up with Patrick, he's put up his information. So hopefully we'll come back and maybe in later on in the year or early in next year, we'll get him back in here for an update on what's going on in this area because it is exciting. Thanks again, everybody. This is the Camp Plan weekly webinar, and we'll see you next Thursday. Take care. Bye.
Thanks so much.